Welcome back to Thought Kernel, where we give insight on resonant topics in finance and education. Today, we're explaining how private equity transformed housing into a financial product. This is not just a housing crisis, it's a financial strategy. One where your rent isn't just going to a landlord, it's going to Wall Street. This is the story of how private equity firms turn single family homes into tradable assets, and how this shift is making it harder than ever for you to afford a home. Look at this house. It's not a home, it's a trade. And you're the yield. Wall Street figured out they can do with rent what they did with mortgages in the 2000s. Turn it into a cash flow machine. And just like before, it's being packaged, sliced up, and sold to investors. This isn't conspiracy. It's public, legal, and it's reshaping the housing market right under your feet. Rents in major U.S. cities have risen 30 to 60% since 2020. Headlines now read shocking warnings, such as record rent hikes, permanent affordability crisis, and asking how we're going to deal with this crisis. In places with high interest like Phoenix, Atlanta, and Miami, people are being outbid by families. They're being outbid by all cash institutional buyers. And those buyers don't want to live in the house, they want to extract income from it. So, who are these buyers? Names like Blackstone, Pretium Partners, and Invitation Homes, they aren't real estate machines. They're financial machines. They're not flipping houses, they're buying them and renting them out forever. In their portfolios, a home isn't a home, it's a yield producing asset, just like a bond, just like a stock. And this is a diagram that displays the 6% ownership institutional and small national investors have of single family rentals in the United States, which amounts up to around 1 million homes. Furthermore, here's where it gets really financial. After the 2008 housing crash, these firms swooped in and bought foreclosed homes by the tens of thousands. Then they invented a new asset class, the single family rental. Now, each rent check from tenants is collected, bundled together, and packaged into securities, literally turned into a financial product. Rent, pooled, securitized, sold. This isn't renting, it's structured finance. The result? A new class of asset rental backed securities. They work like mortgage backed securities that blew up the system in 2008, but this time it's rent payments fueling them. Your rent gets packaged into bonds, rated by agencies, and sold to institutional investors for more money. You're not just covering your landlord's mortgage, you're feeding a yield product. That monthly payment, it's part of someone's income stream in Singapore or Zurich. To Wall Street, your rent is collateral, a predictable cash flow, a low risk product in an era of inflation and uncertainty. These rent backed securities are bought, sold, and traded on secondary markets. And as long as rent stays high, they stay profitable. So, what's the incentive to lower rents? There isn't one. The system only works if you keep paying more. So, what does that mean for the rest of us? It means higher prices, less supply, more competition from billion-dollar funds. When institutional investors dominate the market, home prices inflate and building slows. Because why build more if you already control the cash flow? You're not just priced out, you're being outcapitalized. Try competing with someone who can buy 500 homes in a single zip code. Sight unseen. Housing isn't a human right, it's an income stream.